So good morning, my colleagues, and I hope everyone is well. Early on a Wednesday morning, I want to pick up here with risk premium, and basically both sides, the issuer and the issue characteristics. Both sides take risk, right, with a bond. So far, basically, risk-free treasuries, you always get paid, right? The government will always pay you. That's why they're called risk-free. They won't default. Risk-free in that sense means that a bond will not default, okay, and you'll always get your money back. Now, when you buy corporate bonds, some of these companies like Enron or companies that are in trouble like Sears and Macy's, they have risk because they may default. So if you buy a bond from a corporation and they're in trouble, you have to add a risk premium. And that gets added to the overall risk that we have here, okay? So I'll type that word risk premium. So here was the risk-free rate that we previously looked at, okay? This was the risk-free rate. And to this, we're going to add, and I'll highlight this in a different color, right? We're going to add the risk premium right here. Okay, so this now increases your nominal risk. You see that? All we did was take this and move this here, but we added the risk premium for some company that may be in trouble. So they say it pretty nice here. The nominal rate of interest for security RJ is equal to the risk-free rate consisting of the real rate of interest plus the expected inflation rate plus the risk premium. And that's the new component we add, okay? So that's the new component, and I got a little screwed up here. Let me drag this. All right, plus the risk premium. And as I said, all companies are different, so the risk premium varies with specific issuer and issue characteristics. So you can clearly see, now this is an older table, but for you notice the risk-free rate for a treasury note is 1.81, and for bonds, the nominal rate is higher, obviously because of the risk premium. And here you have high yield or junk bonds. Notice there's a major risk premium here. Even though these are investment grade, there's still a little extra risk compared to the treasuries. But here for high yield or junk bonds, as they're known, you see there's a high risk component that adds to the return you got to receive. Remember, risk and return go hand in hand. So you can see the risk premium being added. You notice the word here, risk premium? So here's the word risk premium, and here is the risk premium for junk, okay, for junk bonds. Okay, so let's go through this and see what the book has to say about this. I think it's worth listening to.
In a previous example, we saw that when investors invest in a risk-free asset, they want a return that more than compensates them for inflation. Another way of saying this is that the return on a risk-free investment includes the real return plus a premium for inflation. In addition to the risk-free rate of return, when investors invest in something that is risky, they will also demand a risk premium. That is, the return on a risky investment consists of three components: the real return, the inflation premium, and a risk premium. The magnitude of the risk premium will be greater for investments that have higher risk. In May of 2017, 5-year U.S. Treasury notes were paying a return of about 1.81%. Corporate bonds, because they are not backed by the full faith and credit of the United States government, are riskier than Treasury bonds, so they must offer higher returns. Some corporate bonds are riskier than others, and a simple way to gauge the risk of a corporate bond is to look at the bond rating. In May of 2017, investment-grade corporate bonds with bond ratings of Baa or BBB or better were paying 3.37%. High-yield speculative corporate bonds with bond ratings below that of investment grade are riskier, so they offer higher returns, 7.67% in May of 2017. The risk premium is simply the difference in returns offered by a risky asset and a risk-free one, such as the United States Treasury bond. So in May of 2017, we can say that the risk premium on investment-grade bonds was 1.56%, and the high-yield bonds, also known as junk bonds, were paying a risk premium of 5.86%. Risk premiums vary through time. For example, during a recession, investors may view corporate bonds as being riskier than they are in boom times, so risk premiums on corporate bonds may rise. At other times, when the economy is doing well and corporate profits are high, risk premiums on corporate bonds may be quite low. But in both good and bad economic conditions, corporate bonds are always riskier than U.S. Treasury bonds, and therefore they'll always have to pay investors a risk premium compared to the return on U.S. Treasury securities.
Okay, so that was an interesting thing. Is pretty much reiterated what I said. Okay, so the risk premium is going to consist of a number, and you can see here a number of issuer and issue related components. Okay, and here's some of them. Here's default risk, and are they going to meet the contract provisions? So there's a bunch of different risks associated with this. And here's some good review questions if you want to review. So let's move ahead. We're at the end of this section. All right, so we're moving on to corporate bonds now. Government and corporate bonds. So basically, this is an interesting little part up here. When governments and corporations need to borrow money, which they always do, as you know, the country's in debt, they often do so by issuing bonds. Bonds are just loans, right? In addition to the T-bills, notes, and bonds issued by the government, state and local governments issue bonds known as municipal. Now, I own municipal bonds. Okay, I'm in a municipal bond fund, and it's triple tax free. Okay, it's triple tax free. I don't pay state, local, or federal taxes. A corporate bond is a long-term debt instrument indicating that a corporation has borrowed a certain amount of money and promised to repay it in a certain future under certain defined terms. So that's the definition of a corporate bond. You're loaning the corporation money, and they're going to give you interest. Okay, now normally when you get a government or corporate bond, they issue it at the new issues at a par value, typically a face or $1,000. You'll see it written as par, principal, or face value, but it all pretty much means the same thing of $1,000. All right, so they'll give you a set coupon which will never change for the life of the bond. In the contract, they're going to tell you what you're going to get every 6 months in a coupon, and you'll be getting that, and that represents the percentage of the bond's par value that will be paid to bondholders annually as interest. So most bonds make 2 interest payments per year, right? Like I said, you're going to get a coupon every 6 months. Okay, that's important to know, right? And most people, like I reinvest them, right? I don't get a check in the mail. And in that case, the bond pays for 1/2 of the coupon rate every 6 months. All right. So another name for bonds another typical name is fixed income securities. All right. It's called a fixed income security. All right. So the contract that you sign when you buy a bond is called the indenture. And they tell you all the rules of the bond. Okay. We'll make that blue, right? This is the rules. So let's click on this. A legal document that specifies both the rights of the bondholders and the duties of the issuing corporation. All right, so we got that. So that's important to know. All right, so standard debt provisions in the indenture basically specify what? What do they specify? Provisions in a bond indenture specify certain record-keeping and general business practices that the bond issuer must follow normally. They do not place a burden on a financially sound business. All right, so there's certain restrictive covenants which place operating and financial constraints on the borrower. It may say they can't issue any more stock until the bond matures. There's a lot of rules that are issued. So if you look here, These provisions help protect the bondholder against increases in borrower risk. Without them, the borrower would increase the firm's risk but not have to pay increased interest to compensate for the risk. And here's a list of the covenants, right? So these are the most restrictive covenants. All right. So another couple more terms here. A sinking fund requirement is a restrictive provision often included in a bond indenture providing for the systematic retirement of bonds prior to their maturity. So they may have a sinking fund. All right. The bond, now as far as collateral goes, the bond indenture identifies any collateral pledged against the bond and specifies how it must be maintained. Collateral refers to a specific asset against which bondholders have a claim, such as assets in the company, kind of like Enron did, right? A bond backed by some form of collateral is secured. A bond that is not backed by any asset is unsecured. All right, so these are important words here. Secured and unsecured. All right. All right, next term here that's important is a trustee is a paid individual, corporation, or commercial bank, trust department that acts as the third party to a bond indenture and can take specified actions on behalf of the bondholders if the terms of the indenture are violated. All right, so that's you would have a trustee, and that would be in the indenture. All right, so the cost of bond financing is generally greater than the issuer would have to pay for short-term borrowing. The major factors that affect the cost, which is the rate of interest paid by the bond issuer, are the bond's maturity, the size of the offering, the issuer's risk, and the basic cost of money. They also have to pay the investment bank, right, for a new issue, for doing the IPO on that bond, okay? So there's a lot of costs associated with issuing bonds. All right. Generally, as we noted earlier, long-term debt pays higher interest rates than short-term debt. And this is a real important statement. Don't forget that statement, right? Because of the maturity risk. All right. That's important. In a practical sense, the longer the maturity of a bond, the more sensitive the price of the bond will be to future changes in interest rates, which increases the risks of long-term bonds to investors. All right, so the size of the bond offering also affects the interest cost of borrowing. So if basically it's a large offering, okay, that's going to affect the price. But it's in an inverse manner. Bond flotation and administration costs per dollar borrowed are likely to decrease as offering size increases. So it's inversely related. However, the risk to the bondholders may increase because larger offerings result in greater risk of default. Okay? All right, so there's a lot of different terms, and you should read through these. All right, I'm going to shoot over to a convertible bond because that's an interesting bond. And bonds that are convertible have what's known as a conversion feature. And it's a feature that allows bondholders to change each bond into a stated number of shares of common stock. But there's a time period by which you can do that, okay? It's in the indenture, and it'll say you have until this time to convert. Now, because you have a bond that's convertible, you have an extra feature, so you're going to accept a lower interest, a coupon rate or interest rate, right? That should make sense to everybody, right? Because you have something extra, right? So, that's an important point to understand. All right, now the next term that's important is a call feature. Companies have the right to call back their corporate bonds if interest rates change and they could refinance their debt. Let's say they have a coupon going out now that's, let's say 6%, okay? And interest rates have now gone down to 2 or 3%. and they can issue new debt at 2%. They're going to call back their bond at a different price so they can save money on a new issue and pay less coupon. Okay, but if you have a bond that's callable, you're going to get what's called a call premium because you have something that's got more value. So you can see here the amount by which the call price exceeds the bond's par value is called a call premium, because basically you're taking a little more risk, so you're going to get a little bit more return. All right, so a lot of bonds can be called back. So this premium compensates bondholders for having the bond called away from them. To the issuer, it represents the cost of calling the bonds. So this call feature enables an issuer to call an outstanding bond, and here it is, right? When interest rates fall, they can reissue their debt and issue a new bond at a lower interest rate. That's the whole gist of this whole thing here. All right, and if interest rates go up, the call privilege obviously won't be exercised, all right? So that's the way that goes. All right, so I'm going to knock off here, and I think we'll pick up at bond yields from here on. I'll pick up at bond yields. Have a good day, everybody.